Welcome, and thank you for joining the RMI's 7th webinar training, Intro to the Gold Refiner Standard. Please note that the presentation portion of this training will be recorded and stored on our free e-learning academy. All participants are currently in listen-only mode. Please save all questions until the Q&A portion of the webinar. At that time, if you would like to speak, please raise your hand and we will unmute your line, or use the questions box in the GoToMeeting pane. This training will focus on the differences between the gold standard and the other two standards. This is the 7th in a series of trainings, each of which will go into more detail about specific components of the revised standards. This training is primarily intended for auditors in the responsible minerals assurance process, auditing against the revised gold standard. Gold supply chains are complex, making transparency very challenging. Gold is valuable, malleable, and easily transported. Because of its value, gold may be traded in small volumes, making it difficult to trace. Recognizing the complexities of this commodity, the Responsible Minerals Assurance Process, formerly the Conflict-Free Smelter Program, maintains a standalone standard for gold. Before we dive into the revised gold standard itself, let's take a look at what makes gold so unique. The risks in the gold supply chain are particularly acute and extend to risks related to the financial flows in a way that the 3T gold supply chain risks do not. Gold is easy to smuggle, exchangeable worldwide, and traded anonymously through cash transactions. Because of these unique properties, some actors in the gold sector have been linked to financial crimes such as corruption, money laundering, theft, smuggling, fraud, and tax evasion, as well as human rights abuses stemming from organized crime and terrorist financing. One illustration is smuggling illegally mined gold into the supply chain, potentially for uses of money laundering. This may be done by refining the material on site to a high purity level, so they appear ready for the downstream market. In this respect, a supply chain actor may disguise the origin of the material in order to bring it to market. Over the years, multiple reports have documented the linkages between gold supply chains and illicit activities. A few examples include the following reports: River of Gold, gold from children's hands in consumer electronics, money laundering, terrorist financing risks and vulnerabilities associated with gold, gold extracted by children, and organized crime and illegally mined gold in Latin America. The case studies and examples published in these reports indicate that there is still work to be done. The RMAP's new gold refiner standard is based on the detailed guidance of the OECD Supplement on Gold. The Supplement on Gold is more prescriptive than the supplement on 3Ts, meaning it is also less flexible. For example, the supplement recommends specific elements of the systems of material control that are not prescribed in the 3T supplement. As an illustration, there is a requirement to physically segregate and secure any shipment for which there is an unresolved inconsistency. While this is an implicit option in the 3T supplement, it is a firm requirement for gold, therefore resulting in less flexibility for gold refiners in determining how to react to discrepancies and observed inconsistencies. The gold supplement overtly addresses ASM and LSM operations. Accordingly, due diligence requirements, and in particular the requirement to map the factual circumstances and conduct on-the-ground assessments, vary depending on the source. In addition, there is an explicit requirement for LSM supply chains to consider ASM-related risks. Furthermore, the gold supplement includes an annex on how to create economic and development opportunities for ASM. In the gold supplement, there are 4, not 3, red flags associated with gold origin and transit. The first 3 are the same as the 3T supplement, but the 4th relates to recycled or gold scrap that has been refined in a country where gold from Karas is known to transit. As a result of this flag, refiners should pay more attention to countries where governance is weak. Similarly, refiners should be vigilant when operating in areas where informal banking systems are prevalent and cash is extensively used. While all smelters and refiners should be cautious when anomalies or unusual circumstances identified through the due diligence system arise, gold refiners have an additional responsibility to pay attention to this fourth red flag as well. The OECD guidance includes recycled gold primarily for the purposes of identifying if the recycled gold has been used as a means to money launder or to launder gold that has been mined in conflict-affected and high-risk areas in order to hide its origin. Therefore, the scrutiny on all recycled materials should be high. Auditors should request strong evidence that gold is secondary and not primary. In the revised standard, existing stocks of fine gold is no longer a separate category of material, but is rather considered recycled, in accordance with the OECD guidance. This is a change for refiners who previously categorized ingots, bars, and coins as existing stocks, and were required only to demonstrate the date of production. The exception here is for grandfathered gold, in which case date of production remains the only requirement. Refiners should ensure that they fully understand the categorization of materials to enable an efficient and successful audit. Similarly, the due diligence requirements for recycled gold include specification of requirements for investment gold, which is newly defined in accordance with the European Council Directive 1998/90/EC. When reviewing how a refiner has classified materials, they should no longer be using existing stocks of fine gold. Instead, the stocks are either primary or recycled, and the corresponding due diligence requirements would apply. Let's look at some of the core risk areas in gold supply chains addressed by the revised standard. The assessment must cover risks related to both financial and physical flows. For auditors, this requires understanding financial flows and, in particular, how money laundering works. It also means that recycled gold is not considered low risk. Let's begin with a look at financial flows. Financial flows here relate specifically to the ownership of gold, which is not always the same as the physical custody of the gold. When we talk about financial flows, we are following the money in the gold supply chain. In particular, what we're talking about are the risks of illicit financial flows, or the illegal earning, transferring, or use of money or capital. Gold is used as a currency in many instances, and therefore can also be used to launder money or finance terrorist activities. Before conducting a gold assessment against the revised standard, it is imperative that an auditor understand financial flows. For reference, we have a report that we can provide. As a refiner, this translates into understanding these main questions. Where does the money trail start and where does it go? Who is the ultimate beneficiary of the financial transaction? How is money transferred? Is it through cash, gold, or through traceable means, for example, through a financial institution? In order to assess this, a refiner can look at financial flows as a pyramid. At the base of the pyramid is looking at the country-level risks. This requires understanding, as part of the procedure to identify CARAs, which countries have weak or unenforced anti-money laundering laws, anti-corruption laws, customs controls, and other relevant government insight, and where informal banking systems operate or cash is extensively used. These countries are high risk for illicit financial flows and should be factors that gold refiners include in their assessment of whether or not an area is a CARA. It is important to note that auditors should check the process by which this is conducted, but not make a judgment statement about the outcome. For example, let's look at a refiner, Refiner A, located in Peru. Peru is not a member country to the Financial Action Task Force, or FATF. Let's say Refiner A develops an AML policy that states the refiner will not conduct business in countries considered high risk and non-cooperative by the FATF. In our example, Refiner A purchases gold from a trader in Ecuador, a jurisdiction considered by FATF to have a strategic AML deficiencies. But for the refiner, Ecuador is relatively close and has other strategic advantages. In that case, the auditor should question the decision to do business with the trader from Ecuador because it violates the refiner's policy to rely on the FATF's assessment. In contrast, if the same refiner in Peru chooses not to use FATF best practices, the auditor should not impose any FATF lists on the auditee or otherwise assess their processes against those guidelines. At the next and narrower level of the pyramid, the refiner should assess the organizations involved in the financial transactions and the methods of payments they use. Refiners must check organizations against relevant sanctions lists, including but not limited to the UN sanctions list or the OFAC list, to ensure those organizations are not known terrorist groups, organized crime groups, or otherwise sanctions from doing business with the refiner or its customers. It is worth noting that these checks are required for the gold supplying counterparty, not any organization involved in a financial transaction. Similarly, a refiner should check to see that the method by which payments for gold throughout the supply chain are made. Cash deals can be a sign of money laundering or terrorist financing. Untraceable transactions may also constitute a red flag. Again, the auditor should focus on the process the refiner has to verify the form in which the transactions are made. For example, refiner A receives $10,000 in cash from customer B, who claims this is the only method of payment in their jurisdiction. This in and of itself is not necessarily a red flag, as there are certain places where cash transactions are the way of business. However, when refiner A asks for the $10,000 to be supported by verifiable information, such as notarized contracts and receipts, customer B cannot provide them. In that case, refiner A should consider this a red flag. As a result, refiner A must dig deeper to understand if this is a case of money laundering activity. The final point in the pyramid is for a refiner to identify if counterparties' beneficial owners are wanted money launderers, known fraudsters, terrorists, or otherwise sanctioned individuals. This information is available on sanctions lists at the national and international level. Engaging in business activities with entities wanted for these crimes or appearing on a sanctions list is not just against the standard, but may be a crime in the refiner's jurisdiction. Even if it is not a crime in the refiner's jurisdiction, it may be so for the refiner's customer. As an example, refiner A is a US-based company and purchases gold doré directly from a mine site in country X. When conducting KYC on the mine, refiner A asks for the beneficial owner's name and scans the name across known sanctions lists. Upon this scan, refiner A learns that the beneficial owner is part of a drug cartel that is on the US OFAC Specially Designated Nationals List, or SDN list, and it is forbidden for American companies or individuals to do business with him. Refiner A then cannot do business with the mine in order to be in legal compliance, as well as in conformance with the standard. Moving now to physical flows. When we talk about physical flows, we are talking about what has been discussed in previous trainings regarding how the material, in this case gold, physically flows through the supply chain. For example, a trader may purchase gold from a miner and store it in a warehouse. While the trader maintains ownership over the material is in the physical custody of the warehouse and under the physical control of the warehouse operators. Similarly, a customer may commission a refiner to refine its gold jewelry. While the customer maintains financial ownership of the gold, it is physically located at the refiner during processing. The expectations for strong systems of control and transparency over the supply chain are very similar to those of 3T. Refiners will map the supply chain to understand where the gold comes from and the route it takes to arrive at the refiner. Similarly, the refiner will identify the actors who physically or otherwise have custody over the gold from the moment it is mined until it reaches the refiner for high-risk sources. Finally, the refiner will identify, assess, and mitigate the risks associated with the gold, for example, by determining if it comes from ASM or LSM, if it is recycled or mined, if there are discrepancies in its appearance upon the arrival at the refiner, etc. The auditor's role is to assess whether there are systems and processes in place to ensure that these activities are in line with the refiner's policy and meet the requirements of the standard itself. There are a few differences with regards to the physical flow that are worth noting. First, it is both easier and harder to trace gold than 3Ts. It is easier because of the high value of the commodity. Supply chain actors often have detailed records for what happened with the gold, and those records in turn can be used to follow the gold through the supply chain. Additionally, many bullions, such as those verified by the LBMA, are required to be stamped and are therefore recognizable upon inspection. At the same time, small volumes may mean traceability is more challenging in high-risk supply chains. Material can be carried in pockets or luggage, and there may be no traceability documentation at all. Complex supply chains and CARAs may make standard documents difficult to obtain. As a result, refiners should carefully consider how material traceability is required to be documented. One of the improvements of the standard is that it summarized basic due diligence expectations for sourcing from supplying smelters that are not RMAP or equivalent conformant. Of note, these criteria explicitly require a risk-based site visit to all supplying refiners who are not RMAP or equivalent conformant. While there are more explicit requirements for internal material control, there is also no requirement to conduct a mass balance. However, refiners must be able to reconcile inputs and outputs of gold over a given period of time. ASM miners are highly mobile and operations are often informal. This is partly why it is difficult to obtain information about gold sourced from ASM sources. Quickly changing circumstances in artisanal gold mining make it challenging for upstream assurance mechanisms to implement robust systems. While there are a number of upstream assurance mechanisms such as Fairmind and Impact, most of the systems are currently small scale. As there is no one-size-fits-all solution, refiners may engage in their own due diligence. As a result, auditors should become familiar with the refiner's due diligence. Auditors should refer to Model 6, Enhanced Due Diligence, and review the ASM Annex to understand those requirements. There are a number of additional factors that need to be taken into account when assessing any actors in the gold refiner supply chain. While refiners remain responsible to implement due diligence, auditors need to understand the risks in the gold supply chain, as well as what constitutes sufficient management systems to assess and address those risks. The main differences for auditors auditing against the gold standard as opposed to the 3T standard can be summarized into 4 points. First, auditors must understand financial flows and risks related to money laundering or financing of terrorism. Second, auditors may find that risks related to armed conflict are integrated into existing due diligence systems for anti-money laundering and know your counterparty. Third, auditors cannot consider a recycled material as low risk and should consider all material primary with corresponding requirements unless the refiner can reasonably demonstrate the material is secondary. Similarly, properly recycled gold also presents AML risks that must be taken into consideration. And finally, auditors may find refiner-owned due diligence systems for CARAs.